Wall Street's name has been removed from Canadian dollar bonds for the first time. There wasn't a single American bank logo in Ontario's $2 billion bond issue, or Alberta's $4 billion megatender. Although the port cranes appear to be running, red alarms are sounding on Bay Streets. The half-century-old balance of North American finance is cracking, with London and Frankfurt filling the empty seats. As Canada's cabinet urges, expand your market in Asia, tariffs with Washington are now dividing not just trade but capital flows. Can supply chains withstand this sudden maneuver, or has the dollar empire suffered a fatal wound? Don't miss the answers. Subscribe and turn on notifications because this video will shake both your wallet and expectations. The global markets. Ontario's $2 billion 10-year U.S. bond issue in early June was one of the moments that crystallized U.S.-Canada relations. The bonds sold out quickly, and pricing wasn't even on the global agenda. But for the first time, the American bank signs were missing from the auction table. Their places were taken by Barclays, RBC, CIBC, and Scotiabank. There was no champagne popping at the celebration, only a quiet handshake, a few drops of sweat on the brow, and the acceptance of a harsh reality. The tariff duel with Washington had finally spilled over into the financial arena. This gesture was dismissed as a brief headline, seemingly a political show of force, yet its echoes reverberated through Bay Street corridors for days. Because the currency in which the bonds were sold was still the green banknotes printed by America, and the sacred pool of liquidity was still flowing on the other side of the Hudson. Nevertheless, Canada had begun to dig its own canal instead of sitting on the edge of the pool and watching the water flow by. By mid-March, Alberta had pushed Bank of America off the list with a €4 billion issuance. Members of the Risk Committee seated on the 27th floor of Calgary Plaza leaned against the glass facade and watched the sunlight shimmering over the snow-capped mountain silhouettes, forced to make decisions with the confidence that Europe will pick up the pieces. This new window opened in euro signaled a repricing of risk for many bond desks in Canadian banks. Updated collateral calls on BB-rated loans asset managers expanded positions hedging the euro-dollar spread on swap desks. These developments also touched personal stories on a micro level. Elaine, a local pension fund manager in Edmonton, cleared her calendar of Washington flights. She conducted her quarterly market pulse check, this time over lunch with EU regulators in Frankfurt. A broker at a London swap desk didn't bat an eye when processing a request from Toronto to swap USD for GBP. The atmosphere on the ground was now fueled more by stagnation than surprises. As tremors grew in the lower layers of credit markets, Ottawa also quietly accelerated efforts to encourage new export chains. Some dusty target market folders were pulled down from the shelves at Export Development Canada's offices. Green lines extending to Southeast Asia were updated, and plots adjacent to Brazil's Santos port were reported as strategic storage areas. An unexpected number of Vietnamese brokers attended this year's logistics fair in Montreal. All were asking how they could optimize Canada's freight insurance terms without using US-based bank guarantees. Meanwhile, there was also a nervous stir behind the scenes in Washington. Canadian bond commissions were among Wall Street's profitable but relatively quiet segments. When they are cut, no one makes headlines the next day. But when you look at the December-end premium tables, the missing percentage points sting like salt when a few senior names at JP Morgan were unable to add a Canadian line to the new tender schedule, and insurance brokers' question, if you remove a small stone, will the wall shake, echoed through the corridors. Ontario's tender restrictions were not limited to the bond desk. A small but critical clause added to the provincial regulations at the end of April mandated that no contracts be awarded to U.S. suppliers unless no domestic suppliers are available. This meant that every item in public tenders, from steel rivets to IT consulting, had to first be sourced within Canada, then from allied countries, and only as a last resort from the U.S. When a state hospital's electronic procurement platform received a bid from Stockholm instead of Seattle, the procurement manager initially hesitated. However, after factoring in currency fluctuations, the cost-benefit ratio of Scandinavian solutions in the IT segment became surprisingly attractive. The real turmoil was felt in the lower tiers of the foreign exchange markets. The Canadian dollar had lost value in the first week of the tariff war, then caught its breath with the rise in Brent oil prices. However, Ontario and Alberta's gradual withdrawal from the U.S. syndication added a technical partial break to the USDC ad. PARs decided to expand their liquidity buffers in their nightly reports. A commodity trading firm in Vancouver passed on the message that it's a bit harder to find dollars after 6 in the evening than it used to be. So this was the first time such a restriction code had appeared on the table since the 1998 Asian crisis. The repricing of risk in Canadian balance sheets also, presented opportunities for local firms. For example, a mid-sized solar panel assembly company in Thunder Bay actually doubled its domestic market share, thanks to additional tariffs imposed on Chinese-made panels. However, the supply chain, it remained global. When copper coil shipments from Shanghai were delayed by 3 weeks, production lines came to a halt on a Tuesday afternoon. As inventory costs and financing burdens fell on small producers, the fragility of domestic gains became, pretty evident. Meanwhile, a different momentum was emerging in the oil and gas corridor. Alberta set its sights on new oil loading ports in the Gulf, and tanker routes were planned to extend from the Pacific to Asia. So this move not only expanded Canada's export basket but, also brought it closer to its goal of financing a portion of the dollar supply independently of US banks through European insurance consortia. Using the Brent basket created a natural buffer for the CAD par. However, when risk premiums rose amid pipeline protests, European investors began to take a much more cautious approach to projects that conflicted with green finance criteria. In this chess game of financial integration, the US still holds the trump card. Even though the White House is signaling a gradual normalization after Trump, the shadow of the tax wall is still hanging over the financial tables. Canada's risk managers aren't planning to go back to full dependence even if the headline says tariffs are gone. Diversification has found a permanent place in strategy documents. On swap desks, models indexed to the European Central Bank's curve are on the rise rather than the Fed's. When London custodians opened sub-accounts for Canadian files, it became clear that the temporary deviation had turned into a permanent intention. Direct capital flows between Canada and the US remain massive. By the end of 2023, US companies' investments in Canada will approach $500 billion, while Canadian funds portfolios in the US are pushing the $1 trillion mark. However, the silent language of numbers reacts more slowly to the high-frequency noise of politics. In other words, the slopes of this capital mountain are solid for now, but the snow cover on the upper layer, warmed by tariffs and nationalist procurement rules, poses an avalanche risk. Most analysts wrote in their reports that it is impossible to sever the deep integration at its roots, but even a small increase in the risk premium is enough to shorten bond maturities and raise guarantee fees. A small building insulation materials manufacturer in Montreal discussed moving its new factory from Ohio to Saskatchewan. The reason was not tariffs, but uncertainty over financing terms. On the same day, a Boston-based asset manager did not close its position in Canadian provincial bonds, but opened a cautious hedge for the scenario of a 5-year trade war. As eyes once again turned to Bay Street, skyline, the rain has already turned to snow and the mud beneath the street lamps has hardened. Behind the semi-transparent layer of ice, a new landscape is emerging. London banks, Frankfurt brokers, Singapore swap desks, and Tokyo institutions are leaving small but, permanent marks on Canada's financial landscape. Whether you call it a symbolic break or strategic insurance, the North's quiet banking revolution has drawn a thick line. The dance with the neighbor will continue, but the music's rhythm will now be much louder. As Bay Street turns toward morning, a single concern reignites in analysts' eyes. If this polyphonic rhythm cannot find its own harmony, will Canada truly be able to hold its breath beneath the icy water, or will everyone left in the cold water suffocate simultaneously? Until new pipes are laid, time will tell. As new veins stretching from the Singapore dollar to the pound, from oil to rare earth metals seek answers, a single sign of blockage is anticipated both in Toronto's granite towers and Calgary's pumping stations because finance, like water, finds its way as long as it can find a crack to flow through without being trapped by the ice sheet or bursting the veins. What are your thoughts on this matter? Please share your opinions in the comments section. To stay updated on new videos, please subscribe to our channel and enable notifications. Thank you for watching.